So we're we're a couple minutes obviously past, and I hate to have you guys wait. So we'll go ahead and get started. For those of you who don't know, my name is Jack Kiley. I am one of the principals of MidAtlantic IRA. We're a provider of self-directed retirement accounts, and we specialize in alternative investments. Our niche is primarily real estate and lending. Most of our clients, I would say, probably about a good 50-60% of our clients are active in those two asset classes. There's a spattering of other things that people hold, which are all very interesting. The Our topic tonight is investing in real estate with a self-directed retirement account and using leverage. So most of us who are in real estate understand the power of leverage. However, most of what you'll read on the internet will talk about uh, investing in real estate in self-directed accounts, but having to buy outright, and that's not the case. Although there are some specific um, rules, let's say, that you have to go through, and we'll go through those. So obviously, we have a very small group here tonight. Um, so if you have questions along the way, don't hesitate to throw up your hand. Siobhan will, uh, uh, enter, put us all together, and that way we can have a fairly free flowing conversation. Quite frankly, I like that better than just the straight listening to myself pontificate about something. So so anyway, as we go on, so in self-direction or in retirement plans, and I'm using the term retirement plan as opposed to IRA, Roth IRA, for solo 401k, SEP simple, etc., because these rules pertain to all self-directed plans. Okay, so quite frankly, they pertain to every retirement plan. Uh, so so anyway, there's two broad sets of rules, and we always sort of go through this a little bit at the beginning. So what I refer to as the do's and don'ts, and the first thing that you're looking at is what's called permissible investments. So in retirement plans, there's actually a very, very, very small list of things that retirement plans cannot invest in. The list is all of two items, and then I always put a couple of others on there to sort of because they're either administratively not feasible for a variety of reasons, or they're very, very difficult to do. So the first thing the government says that you cannot invest in is collectibles. So think fine wines, works of art, anything that has that collectible nature to it. Okay. The second is life insurance, and I'm going to put a very small asterisk by that, in that certain plans, not ones that most people are familiar with, will allow you to buy life insurance. Okay, but for the vast majority of plans, those two things are not permissible. So a couple of other things that I always put on the list. One is in the IRA world. So Roth IRA, traditional IRA, SEPs, simples, the account cannot make a loan to the beneficial owner of the account or a group of people, and we'll talk about these people a little bit later, which are referred to as disqualified persons. And the reason I mention that is because most of you probably have a 401k plan or have been a participant in a 401k plan before. And 401k plans, many of them, probably about 85-ish percent, allow participant borrowing. So in 401k plans and the like, permissible. IRAs, not permissible. Okay. So if you take money, quote unquote, out a loan out of the IRA, we just call it a distribution and it's taxable. Okay. So that's one thing. The other, for the moment, are cannabis types of assets. So think grow farms, dispensaries, those sorts of things. And the reason for that is not an IRA issue or a retirement plan issue, it's a banking issue. So at the moment, cannabis is either legal or in the process of being made legal in probably about 30 states. But on the federal level, it's still illegal. Okay. So if I have an account, I live in Maryland. So if I have an account and I'm in Maryland and I'm invested in a grow farm in Colorado, where it's pretty much fully legal, if I move that money out of Colorado to Maryland across a state line, that's that's money laundering. So, um, so the banking, this is a an asset class where it's not uh, it's not forbidden in the retirement plan spectrum, but it is in banking. So that's it's just at the moment it's not feasible. And for those of you, if any of you are thinking about that kind of an asset, really what I would do is I just watch the legislation. So currently there's a number of bills in Congress that are either in the process of just making it outright legal, okay, at the federal level. And it would be, quite frankly, if they did that, then they could just tax the hell out of it and we could maybe be out of debt. But that's another story. Or really, what there are another set of bills which are talking about moving marijuana or cannabis from a class one um, narcotic, which is in the same group as heroin and fentanyl and those sorts of things, to class three, which would put it in the same boat as Benadryl and you know aspirin, I guess. So if either one of those two things happens, then the that asset class becomes wide open. So those are, at the moment, those are the things that are either not permitted or just not feasible. Okay. So for most of us who on this call are thinking about real estate in some fashion, real estate's fair game. Okay. And we'll come back to that in a second. The second set of rules deals with who the retirement plan can transact business with. And transact business is any financial transaction. So buy, sell, lend, lease, borrow, uh, and then a couple of other things. So use, assets, facilitate, guarantee loans. Okay. So when you're thinking of this, really what the government is these rules, the disqualified person rules, are designed to ensure that retirement plans are that people are not using their retirement plans for current benefit or using the assets or the backing of their retirement plans to enhance their personal well-being or vice versa. Okay. So they're worried about shifting assets or funds from taxable environments, which would be what you hold, to tax deferred or tax free. Okay. So that's what these rules are designed for. And the disqualified persons fall into three categories. So the first is family members. So if you reach out there in space and you put a dot, and that dot is you, and I'm assuming this is your account, your retirement account, and you draw a vertical line through that dot, anybody that's on that vertical line is disqualified. So ascendants, descendants, spouses. So for instance, if it's my account, I cannot buy a property in my retirement account that my father owns. Okay. I can't rent it to my son, even at fair market value, because he's got the use of the asset. Okay. So if you let's just peel that back for a second. So let's go to the first thing. If I buy an retirement account for my father, first of all, how did we arrive at price? Okay. Because we're sort of on both sides of the transaction, right, Willie? If you think about when you're negotiating anything for the purchase of anything, there's a competition, right? The seller wants one thing, the buyer wants another, and you sort of come to the middle somewhere on a price. Okay. If I'm chief cook and bottle washer, so if I'm both on the buy side and the sell side, how did we arrive at price? Okay. Secondarily, if I buy an asset from my father, for instance, maybe I am moving a piece of real estate in my example from a taxable environment and maybe at a value that's not correct to a tax deferred environment, right? Which is my retirement plan. Okay. So, and then the income would be sheltered there. Okay. So the IRS is looking for willing buyer, willing seller. So, they're looking for that uh, sort of, and I'm using this term softly, that adversarial meeting of the minds to arrive at price. Okay. So if we go to the other example, which is renting to my son, okay, even at fair market value, here my son gets the use of the asset. So the asset is in a retirement plan, okay, and he is using it personally, okay. The reality is, if he's in school, for instance, and I rent it, so it's not unusual that a parent will buy a piece of real estate in the college town where a child lives and then rent it to him and his buddies. If I were to do that in my retirement account, and my son has all his frat buddies over one night and they have a drunken raving party and they punch holes in my wall, what am I going to do? Right. If it was if it was John, I'd sue John. I would I'd go after him, right, for damages and all that. If it's my son, I'm probably going to yell at him a lot and fix the holes. Okay, so I'm very likely to treat him differently. But the reality is he's got the use of the asset. And in the retirement plan world, anytime you have constructive receipt or use of an asset in a retirement plan, that's a distribution. So if you think about it, when you take money out of a retirement plan, what happens? Now you have constructive receipt of the money, and that's taxable to you. So if I allow my son to use the property, he's got constructive receipt of the property, right? That's a distribution. Okay. Second group of disqualified persons is people that work on the account or work for the account. So, for instance, if you have an account with us, I can't buy an asset from your account because I work for the account. I work for you. Okay. So if somebody advises you on the account, that person is disqualified. Okay. And then the last group in tax law, there's always the easy rules, and then there's the fuzzy, and this is the fuzzy, and it's called certain other business relationships. And for this, the best way to illustrate this is by example. So if Brooke and I are invested in an apartment complex, let's say, and Brooke owns 8% and I own 6%, we are not going to be disqualified with respect to each other. We're just merely invested in the same thing because between the two of us, we don't control it. We're not making policy. We're not part of management. Hopefully we're catching payments, right? Okay, so we're not disqualified. If, on the other hand, Brooke owns 35% and I own 25%, now we are disqualified with respect to each other because between the two of us, we control the entity. We own more than 50%. Okay. So we can dictate policy. We can set terms. We could we control the asset. Okay. So, and this is sort of a facts and circumstances kind of thing. And in real estate, the reason I always mention these rules in the beginning is because in especially those of us who are in real estate, you know, I'm a CPA and I've got a tax practice, and I've been looking at real estate transactions for I got a lot of gray hair, so for a long time. Okay. And they are the most complex. I think real estate people, if there's a hard way to do something and an easy way to do things, we always take the hard path. Okay. They're always the most convoluted deals, the most, uh, you know, bunch of people involved. I mean, it can get complicated real fast. Okay. So if you can kind of keep those disqualified person things in your at least in the back of your mind, you'll be much better off. So that's a very broad brush of the do's and don'ts in retirement plans. Before we move on, does anybody have any questions on that?
I do. I don't know if this is the right question for this segment, but the last example that you gave as far as controlling interest in property, um, so that's forbidden altogether. I think I misunderstood. So that's just when you own a portion of it, or
Well, let's say for the sake of discussion that, let's go back to that example. So if you own 35% and I own 25% of an asset, and we maybe, this has nothing to do with retirement plans. So you put in 35, you put in your piece out of your funds. I put my, out of taxable money. I put my part in out of taxable money because we control a significant asset. Okay. You and I are linked, so to speak. Okay. So, what the government doesn't want us to be able to do, and one of the questions I usually get in this is if my friend, I have a friend and we're not disqualified, but if he lends me 50,000 and I lend him $50,000 out of our retirement accounts, can we do that? And the answer to that's no, because it's just a quid pro quo, right? They're very likely linked transactions. Okay. So, and this is, again, this is what the government is looking at. And, a lot of times where I'll see this is there will be partners in, it might not even be an investment. So you and I, maybe we have a consulting business and we're 50-50 partners. Okay. We're disqualified with respect to each other. Okay. Because we're financially connected, and that's really probably the better way to think of this. Okay. And if you have an account with us, we and you're contemplating a transaction, we are, I think we're probably about the only institute, group out there that we want you to call us and run your scenario by us first, because especially in real estate, because it is it it doesn't serve either you or us to get 2/3 of the way down the pike on a transaction and then find out you can't do it. It's obviously it's incredibly frustrating for you. You put a lot of time and effort into it, but at the risk of sounding self-serving, it doesn't help us either because we're not going to get paid. So we want to, we want to sort of ferret that out in the beginning. So hopefully that helped.
yes, thank you.
Yep. Anybody else have any questions on this? Somebody's got a hand up there. Major Tom.
Hi there. Yes, on the life insurance, are you talking about like IBC, whole life type policies?
Well, what I'm talking about is I can't buy a policy, either term, whole life, or anything else on my life. Okay, out of the retirement plan. Okay, so and if you think about this, what's happening there is I am insuring something, right, or I'm investing in something that is, I'm disqualified with respect to the retirement account. So if you go back to the first group, family members, and you put a dot out there, and I'm the dot. Okay, if I'm putting a policy, and if the plan is putting a policy on me, that's disqualifying because I can't. We're disqualified. Okay, so hopefully that makes sense. Cool. Anybody else? All right. So let's move on. Let's move on to real estate. So as I said before, real estate is probably the single biggest asset class that our clients hold. Okay? And real estate can be held in many forms. So typically, the account is so an IRA by definition is a trust. Okay. Obviously, it has obviously special taxing, tax attributes, but by definitionally, a retirement plan is a trust. Okay, so trusts can hold obviously all assets, and it is at least here, it is probably the most common ownership is in sort of two types. One is either just outright ownership by the account. So if it's my account, the real estate would be titled MidAtlantic IRA FBO, which is for the benefit of Jack Kiley, IRA. Okay. And that would be the holder of the real estate. So if you looked in the land records, that's what it would read. Okay. So in the old days, we used to be able to if you wanted to try to inject some anonymity there, we used to be able to do MidAtlantic IRA FBO account number 12345, comma IRA. Okay. Many jurisdictions will not allow you to do that anymore. Okay. So some will, but recently, I would say in the last 2 years, uh, many are saying, no, 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 you can't do it. Okay. So, so anyway, that's a question that usually comes up too. So the other avenue for people is either to partner with other accounts. So it's not unusual that husband and wife partner their accounts together. So husband IRA, right, wife IRA, or there might be, so maybe Joe and Brooke and John and I form a little LLC. And some of us use retirement plan money, some of us might not, but we form an LLC and then we invest in the LLC and the LLC buys the real estate. So those are generally the two or three main avenues. Okay. So because I know you're all very astute listeners, if I said husband and wife, a little alarm should have gone off in your head and you said, hey, dude, didn't you just go through about 10 minutes of disqualified person and the dot and the sentence descendants spouses aren't they disqualified? And the answer to that is yes, they are. However, if you are investing in something at the same time, nobody's buying anything from somebody else, right? You're partnering together. So if my wife and I, for instance, used retirement plan money, or if we used retirement plan money, her IRA, my IRA, and we bought the same asset, we would buy what's referred to as undivided interests. So if any of you have been out west, it's tenants in common, which is not on the East Coast. You don't see a lot of tenants in common types of transactions, but out west, that's a big, that's a big form of ownership. Okay, so another way to say that is undivided interest. So we might title the property, MidAtlantic IRA, FBO, Jack Kiley, IRA 45% undivided interest, and wife IRA 55% undivided interest. Okay, because she always has more money than I do anyway. Um, so so that's not uncommon. Okay, so any type of real estate can be invested in self-direction. So could be single family home, could be raw land, could be apartment, condo, townhouse. So, any type of property is uh, is permissible, even overseas. Okay, so we have a lot of clients that invest in other countries, real estate in other countries. The only caveat to that is countries that are on the State Department's no list. So, that would be places like Iraq, Iran, Sudan, Venezuela, um, Cuba sometimes is on that list, sometimes is off. I think right now it is on. Um, uh, China, North Korea, you know, most places you probably wouldn't want to invest anyway. Okay? So, but it's not. So even over. So my point to all that is even overseas is an option. Okay. Um, you know, any form of ownership is permissible. So outright ownership in partnerships, in LLCs, undivided interests, all those things, as I mentioned, are permissible. The only entity structure that is not permissible is S corporation. Okay. And the reason for that is S corporations can only have individuals as stockholders. Okay. And quite frankly, putting my CPA brain on for a minute, holding real estate in an S corporation is not the best, even outside of retirement plans, even for individuals, is not a great avenue for entity choice because there's basis limitations and there's a whole bunch of other things. But typically, what we'll see is either limited partnerships or LLCs. Okay, so a very sort of simple transaction might be let's just talk about an outright purchase. So if I'm out looking for property, first thing I want to do is you want to make sure your account is established. Okay. And when you're out looking for property, when you make your offer, you want to make it in the name of the IRA. Okay. So I make my offer. I want to buy 125 Main Street, and I'm going to make it in the name of, I'm going to make my offer in the name of MidAtlantic IRA, FBO, Jack Kiley, IRA. Okay. And if I want to give myself some flexibility, I might say and or Jack. Okay, me. And the reason that I can do that in the beginning is because up until settlement, nothing is set in stone. Okay. So that gives me flexibility to either buy it in the retirement plan, invest in it in the retirement plan, invest in it personally, or, you know, uh, possibly assign it to somebody else. Okay. The one thing that you cannot do is assign a contract, okay, from you to your IRA, which is why the IRA has to be in the contract at the beginning. Okay. And the reason for that is in tax. Okay. Whether there is an exchange of money or not, if there is an exchange of something. So in this case, if I was assigning something, for instance, to Joe, okay, although I like Joe, and although Joe is really a nice guy, okay, I expect to be paid, right, for the assignment because the contract was mine, so I controlled the asset. And when I assign it to Joe, he's, that's for value. So he's going to pay me something. If he doesn't, or if we decide that there's, I just say, you're a good guy, take it. Okay. the IRS will perceive a value to the transaction because nobody gives something to somebody else for free. That's we're in Adam Smith world. There's no such thing as a free lunch. Okay. So so if I assign something from me to my retirement account, it's perceived to be for value, right? Okay, because you got to think of you being separate and distinct from the retirement account. It's like Jack and Jim. They're just you're different people. You're totally disconnected. Okay. So so the minute that there's an exchange of value, that becomes disqualifying, right? Because remember, I can't buy something from the retirement account, right? So I can't assign something, okay, because it's perceived to be for value. Okay. So you want to make sure that the retirement plan is in the offer. Okay. And the other reason that you want to do and or you and at least this is just one of my things. Okay. Is that as you're negotiating the deal, okay, you can you can deal with all the back and forth and initialing and signing and offer, counter offer, and all those sorts of things without having to run to the custodian for to deal with all those things. Okay, because you're at least in the beginning, you're a party to the contract. Okay. So with us, once you have a signed contract, that's when we want to know about it. Okay. So if your account is with us, you're going to contact our acquisitions team. Um, you know, put us in touch with the settlement company. There's obviously a little bit of other paperwork. It's called a bi-direction, which is which is a form which authorizes where you're authorizing us to, or you're directing us, quite frankly, to buy 125 Main Street in your retirement account. Okay, and then we'll contact the settlement company, make sure they know it's an IRA. And really what we're doing is we're looking to make sure that the vesting or the paperwork is properly titled, those sorts of things. Every other institution out there that does this doesn't want to see any of your paperwork until you have it all together. Okay. The reason that we want to know early is twofold. First of all, I'm back to, client experience, right? If you can't do it, we don't want to go down the road. Okay. Nothing, I can't tell you how many times I listen to people who are with some of our competitors and they'll say, um, yeah, I submit all my paperwork and I had to close in 2 days and they said I can't do it. Or they held up for this or they held up for that or they needed this or they needed that or this needed to be changed, whatever it is. Okay. All of that is ferreted out early. So we don't, at least at MidAtlantic, we don't have those problems because we're involved at the beginning of the transaction. Okay. Second of all, it helps us with deal flow. So if I know today that I got 30 closings a week from Friday, they're all going to get done. Okay. There's no, as my kids would say, there's no drama, right? If you think about how some of the other places operate, where they don't want to see, um, they don't want any of the paperwork until you have it all together. For those of you who are in real estate, many times you don't have the paperwork until the day before or 2 days before settlement. So how do these companies manage and staff? I mean, you go to work every day and you go, hey, good news, we got a lot of deals today, or we have no deals, right? So it becomes a bit of a workflow nightmare, at least in my opinion. Okay, so that's why I want to know early. So many times we will get the paperwork the same time you do. Okay. So we're going to, once we get a good set of documents from the settlement company, we're gonna send them to you for your approval because we want to make sure it's exactly the deal that you think it is. So we go through what we call a read and approve process, which is all online. It's um, you know DocuSign kind of thing. Okay, and once you sign off on the deal, then we fund settlement. Okay, so title obviously passes to the IRA at that point, and life goes on. So just a couple of other sort of tidbits. Any contracts or agreements with respect to the property. So think about insurance. If you have an HVAC contract, like air conditioning kind of thing, maintenance contract of some sort, all those things are between the IRA and the vendor. So you want to make sure that on that paperwork, it's your IRA, not you personally. Okay. So you want to make sure that that's, you know, all those things are right. And if it's rental property, you want to make sure that tenant agreement is between the tenant and the IRA. Brooke, you got a question?
Yes, please. So you mentioned previously opening an LLCs. So could you open an LLC as a single person entity, buy the property in the LLC, but it's backed by a self-directed IRA, and then all of your transactions are in the name of the LLC?
Yes, you could do that.
So as far as like actual management of the property, you call the plumber, that still could be in the name of the LLC?
Right. So there, two things with the LLC. So first of all, depending on where you live, that's obviously there's a cost to the LLC. So in Maryland, for instance, it's $300 a year. If you're, I live in Central Maryland. If I go 20 miles down the road to Virginia, it's $50. Okay, but the LLC has got to be cited in the state where the property is owned. So it's not unusual, at least here, that somebody might live in one state, but the property that they own might be in another state. So that could create a couple of issues. First of all, you got to have a resident agent. So you can't be the resident agent because you don't live in that state. So that means that there's yet another cost involved. Somebody's got to do the bookkeeping on that, okay? Because we're not doing it, okay? So you're going to have to or pay to have that maintained. Any of the rules attendant to IRAs, so the disqualified person rules, making sure you don't enter into prohibited transactions, all of those issues fall to you now because we can't see any of that. Okay. So, so you've got to make sure that you're dotting I's and crossing T's. And then, probably the last part of that is we're getting to a point with retirement plans too, where you're going to have to submit on the LLC a set of financial statements back to the custodian because the government is asking more about what's going on in these single member LLCs, okay, which are quite
Okay.
frankly they're popular. Okay,
So
so
does that mean, am I understanding correctly? So if you choose the route of taking your self-directed, opening an LLC inside of that configuration, purchasing the property with the LLC.
okay, let me stop you right there because
Okay.
really the self-directed investment is in the LLC. Okay, so basically, you know, you're going to have a lawyer set up the LLC because you want to make sure it's done right. So you're not going to go out to the website and fill out the 5 questions and run with it. Because the other problem is you can't pay the bill. The retirement plan has to pay the bill. If you pay the incorporation fees or the filing fees and those sorts of things, now you've paid a bill for an asset that's owned in the IRA, and that's prohibited. Okay. So you need to wangle some third party involved. And quite frankly, although you might not want to pay a lawyer, I would pay a lawyer because if it's not set up correctly, I want somebody to hang. Okay. I don't want to hang myself. Okay. But as far as the IRA is concerned, the investment is in the LLC. So once the lawyer sets it up and does whatever, and you set up a bank account for it, the funding is going to be, the buy direction is going to be an investment in real estate LLC. Okay. And that's all we do. Okay. So now everything else is in the LLC, and it's done at the LLC level.
Okay. So clearly, I think most of us here know the the big reason, or most of the reason for an LLC is, mitigating of liability. So if you forego the LLC and purchase the property directly with your IRA, that way we keep you involved. Two questions. Is there any liability protection there? And also, how would you do, say, a bank account?
There is no bank. Well, first of all, there's no bank account. Okay. I mean, you have cash in
Okay.
your account, which pays the bills. Okay. So there's not a separate Brook IRA bank account. Okay.
So if
If
there's like a plumbing bill,
you submit a payment authorization to us and we pay the bill out of your account. Okay.
I see. Is there a
Okay.
fee for that each time we do that?
I think there's a check fee, $10.
Okay.
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 The what was the first question? Part of that. I lost my train of thought.
No, that's fine.
The liability. So liability. Remember I said earlier, an IRA is a trust. Okay. So trusts have protections just like LLCs do. Okay. So now, so general liability is going to stop at the IRA door. Okay. But, there are certain things that whether you have an LLC or not, you're not going to be able to avoid personal liability. So one of my, my over the top example of that is if you have a rental property and the tenant notifies you that the banister is loose from the wall and you don't do anything about it. Okay. But you have personal knowledge of it. And, the tenant's child goes up, grabs a banister, falls off, ends up in the hospital, costs $30,000, right? That's a personal liability to you because you had a fiduciary duty to fix something in the property and you didn't do it. Okay, now there's going to be, it's going to be an issue. Well, you just told me yesterday and, today kind of thing. But if it was, a month, you're probably personally going to be on the hook. And it doesn't matter whether you have an LLC or a trust or anything. It's not going to absolve you because you have personal knowledge and you have a relationship. You're the owner, obviously, of the LLC or of the retirement account. So, it, oh, don't, a lot of people think that there's blanket, I'm looking for a different word, immunity. Okay. But there's no such thing. Okay. And even in cases where you're not, I mean, you've probably been through this, you know, everybody gets sued and then they start knocking people off or entities off. So for instance, we always get sued. Okay. And we fall off because we're the custodian. It's not, it's the account. It's not us. Same thing would happen to you. So, any other questions on this? On the acquisition side? Okay. So, so purchasing a piece of real estate is not terribly different in a retirement plan than it is from purchasing it personally or in an LLC or, I mean, hopefully you sort of got the gist that the flow of the transactional flow is exactly the same. The only real difference is naming convention, right? Who owns the account? What's called the vesting on the account. And then, because obviously you've got the custodial involvement, whether it's us or somebody else, there's a process, and they have a process that you have to kind of work through a little bit. Okay, so let's talk about loans for a second. Okay, so in real estate, obviously many of us, especially in the Mid-Atlantic area, we're not buying property here outright, okay, because it's expensive. Okay, so plus, if you're in real estate, you understand the power of leverage anyway. Okay, other people's money, and the same is true in retirement accounts. So if I have a retirement account and I've got 50,000 or I got $100,000 on it, and I want to buy a property for, you know, I, I have a property that comes up for $100,000. Would I be smart to invest everything in that property? Or might it make sense to leverage, invest a portion, okay, of my funds, and then borrow the rest? And that becomes a little bit of a spreadsheet operation to figure out, what makes sense or what doesn't make sense. But the reality again for most of us is if you had $100,000 in an account, you could probably diversify a little and buy maybe two assets, right? Two pieces of property instead of just buying one outright. So you get some diversification, cash flow from two different sources instead of one, those sorts of things. So there's, there could be a lot of advantages, depending on what the carrying cost of the debt is, right? So in retirement plans, though, the borrowing is has to be specific. Okay. So we're looking at what's called non-recourse lending. Okay, non-recourse loan. And essentially what that means is that the lender can only look to the security interest in the property for repayment of the loan. So it's a fancy way of saying you are not personally guaranteeing the loan. Because if you personally guarantee the loan, that's disqualifying because you are giving the retirement account the benefit of your financial wherewithal by the guarantee. Okay. So if you think of this another way, if I were to guarantee, so one of my kids wants to go buy a piece of property. If I guarantee the loan, the lender is really looking to my financial wherewithal for repayment of the loan. I'm sure they're looking at my child, right? But they're primarily looking at me, right? And the same is true if you guarantee something to the IRA or for the IRA. So that is, as we've mentioned a number of times, is prohibited. Okay. So because now you're giving a current benefit to the retirement account. So that current benefit thing works both directions, from the retirement plan to you and from you to the retirement plan. Okay. So we're looking at non-recourse lending. There's a number of options for that. There are some institutions, there's a couple of banks that have programs devoted totally to that, and I'll give you those names. One is North American Savings Bank. Another is First Western Federal. One's in Kansas City. The other is in South Dakota, I think. There are specialty lenders out there. You probably get emails from them all the time if you're in real estate. One of the more interesting ones that I've found about a year and a half ago is a group called Marshall Reddick, and they have a program where it's kind of interesting in that they will lend to IRAs non-recourse, and at the same time they sell those loans off. So they're looking for funding for your deal on the other side. So they're out underwriting loans and they're looking for funding at the same time. So it's kind of an interesting model. So, but anyway, the lending is specific, so it's non-recourse. Okay? Down payments tend to be a little higher, so it's usually about 35% instead of 20. Okay. And what the bank or what the financial institution is going to look at is they're really going to be focused on the cash flow of the property. Okay. So you will very likely have to submit to them a pro forma, what do you think the rents are going to be? What do you think the expenses are going to be? And all those things. And what they're probably going to do is politely ignore what you give them. Okay. So they're going to, which is what banks always do, right? So if you say the rents are, you're going to get $1,500 a month in rent, if the customary in that area is 1,000, they're going to go with 1,000. Okay. Or you got to have a really good reason why you're going to get $500 a month more. So they're going to vet you. They're going to vet your assumptions. And they're pretty. You know, it's not terrible, right? But whenever we have anybody that questions what we do, we always take a little bit of offense to it. So, but so anyway, they're going to take bits and pieces of what you give them, and then they'll make some of their own assumptions, and then they'll make a decision based on that. It's not unusual that that all these institutions come back and they might say, well, we won't lend X, but we'll lend Y. So there might be a little bit of a little bit of horse trading or a little bit of back and forth, and that's not unusual either. Um, so uh, closing usually is about 30 to 45 days. Some will go maybe even a little longer than that, but it's a fairly normal type of transaction. But again, we're back to that non-recourse lending. Okay. Um, the other the other sort of hitch in this is that when an IRA borrows money, okay, so this is IRAs only. So this is IRAs, traditional IRAs, Roth IRAs, SEP simples, anything that's an IRA, as opposed to a 401k plan. Okay. The account might have to pay tax based on the earnings or the net profit derived from the borrowed money. Okay? And it's referred to as a UBIT tax, unrelated business income tax. Okay, so let me just say that again. The account might have to pay a tax on the income, on the net rent, okay, in this case, derived from the borrowed money. Okay, so let me just go through an example. So let's say, for the sake of discussion, that I own a piece of property, and I'm 70% leveraged. Okay, so I put down 30%. I put down $30,000. I borrowed 70. Okay, so my debt ratio is 70%. Okay, I take in rents, whatever that is. I pay out the expenses, whatever those are, including depreciation, okay, on the property. And let's just say, for the sake of discussion, that I come down to a net rental income number of $10,000. Okay, just so I can kind of do the numbers in my head. Okay, so if my net rental income is the 10,000. Okay, what I do, sort of the quick and dirty of this, is I apply the debt ratio, which is 70%, right? So 7,000 of the 10 was derived from the borrowed money. 30% of the earnings came from what I put into what came out of my IRA. Okay, does that make sense? Okay. So, when you work through the UBIT tax calculation, so the UBIT is calculated based on that 70, that 70%. So on $7,000, it might be on the high side, it might be $1,500 tax. Okay. So just for, so remember I said an IRA is a trust. So the IRA pays tax on the trust rate schedules. Okay. So they're a little, they ramp up pretty quickly. Okay. But, it's probably on that 10,000 bucks, it's probably about $1,500 or so. Okay. So in my account, if I borrowed, if I put down 30, okay, and I returned 10 less than 15, $8,500, that 8,500 divided by my ROI, it'd be 8,500 divided by 30, right? It's a pretty healthy number. Okay. So, many times when I'm asked to run these kind of calculations for people, they want to see it sort of pretty, uh, in a taxable environment versus the IRA and, what's the tax aspect and all that. Many times it still ends up being a much better deal in the retirement plan. So you gotta shake those numbers out. But know that there might be a tax that's paid by the IRA. Okay. So that's the one complicating factor when the retirement plan, when an IRA, I should say, borrows money. These rules do not apply to 401k plans. Okay. Interestingly enough, um, I, you know, uh, 401ks, pension plans, profit sharing plans are not subject to what's called UDFI, which is the unrelated debt finance income tax, which is a subset of of the UBIT. And the reason for that is that it's a specific exemption that was put in for unions because many of the unions own real estate. Uh, one of the biggest, for instance, in California, CalPERS owns tons of real estate. Uh, Alabama, or you know, teachers union owns a lot of buildings, and so it's not unusual that these plans hold real estate as assets and leverage the real estate. And the reason, quite frankly, one of the reasons for that is because the return on investment's much higher. So these are pension plans, so they've got people that they got to pay out year in and year out. And if you think about it, the average stock and bond only pays 4%. Okay. If you have a lot of pensioners, you're not going to be able to pay them out based on a 4% return on assets. You got to go to asset classes that have higher returns on investment, like real estate, like loans. You know, I'll give you another good example. In if you go buy a big real estate project, and by big I mean like 30, $50 million, they're building a high res. At the bottom, it'll always tell you, it's financed by, right? And very rarely are those big deals financed by banks because they don't have the lending power. They're usually financed by either pension plans or life insurance companies because the ROI is better for those guys. So anyway, little sidebar. Um, so any questions on borrowed money? Somebody's got a hand up. Brooke.
Me again.
Well,
Um,
you're just the one who asks questions. Everybody else is thinking of it.
I enjoy these so much. I learned so much. I'm a newer hard money lender. So I have questions that perhaps we can talk about another time about how I can use money for lending. But my main question here is if one of my borrowers is using their self-directed IRA and are seeking hard money from me, what are precautions that I would need to take or the borrower would need to take? Am I just understanding that it's non-recourse?
Well, mhm. So if I'm a lender, okay, I mean, what I'm looking at, what lenders are all lenders, you know, they're of course they want a good return on their money, but more importantly, they want to make sure that there's the return of their money. Okay. So, if it's me, I'm looking at things like the, the underlying collateral. So if the property, for instance, that the debtor is looking at buying is in a nice area and the after repair value is going to be, you know, high, okay. Um, I am probably I like that better than in a neighborhood where half the buildings are boarded up, right? Um, because it's hard to swim against the tide, right? Uh, it's sort of that old adage in real estate. You don't necessarily you don't want to have the most expensive property on the block, right? Um, and then, so the other thing that I'm looking at probably is the experience of the debtor. So if it's hard money, I'm looking at, are they matching the borrowing to the project? So is it a short-term deal? So, hard money by definition tends to be, you know, say less than a year. Okay. Is this project going to get done in less than a year? It's going to get done in 9 months. And part of that, it could be jurisdictional. So, if you're doing a project in DC, it is probably going to take a lot longer than if you're doing it in one of the counties. Okay. Uh, so just because DC is a mess, okay. I mean, it could take you a while to get permitted, for
What
instance.
about just, vetting the borrower, or specifically if I'm lending to a borrower that's using their self-directed
Mhm.
IRA, or so are there precautions I need to take, legalities I need to make sure I get counselors through an attorney, or,
Well,
how
you
does
know,
how does that work out? Because I know you mentioned before that they're non-recourse,
right.
which normally I would ask for a guarantee. And then also, there's specific banks you said to do this. So I'm
Well,
thinking about that as a lender. Okay, well, what do I need to be wary of outside
well,
of
I
the
think,
typical hard money scenario?
yeah. Well, I think you're looking at the typical, I think all the typical hard money, considerations apply. Okay, that's just my personal opinion. Um, you know, again, I think the experience of the person and what they're doing matters a lot. Okay. Is this their first rodeo or is this their 10th rodeo? Is this a totally, or do they usually, is this a property that is in their, is the norm for them? So if they normally do single family homes that are you know, 2 baths, 3 bedrooms, is this that, or is this a 5 bedroom? Is this a bigger property? Is it in the area that they normally work in? Because real estate people, rehabbers in particular, they have niches, right? They it's kind of cookie cutter. It's quick in, quick out. Um, you know, all those sorts of things. If you want more money down, okay, you want more skin in the game. So if normally, and I'm totally making this up, if normally you would have, they might be in for 20%. Maybe you want them in for 35. Okay?
And that's big. So I wouldn't be able to ask for a guarantee.
No, that's the only thing you can't do. You can ask for
That's
anything
the only
else.
real change. Okay.
Right.
Otherwise, it's a standard.
Yep.
Got
Yeah.
it.
Yeah.
Okay.
Yep,
Thank you.
absolutely. Yeah, you bet.
Hi. So, yeah, I just want to speak about the recent conversation that Brooke was having. So, yeah, you mentioned about, the guaranteed return. So, isn't it something like when you're lending the money, you can even ask the borrower to put your name on the deed, when going through the deal?
Sure.
Or
Yeah. We're talking about, I just want to be clear. We're talking about, the lender, okay, to an IRA. Just the debtor cannot personally guarantee the loan. Okay. That's what we're talking about. Okay. So not a guaranteed rate of return,
Mhm.
which I think is what I heard you say. Okay. But that's the borrowing. So if my IRA is borrowing money, I personally cannot guarantee the loan or any disqualified person. So I can't guarantee the loan. My father can't guarantee the loan. My wife can't guarantee the loan. Okay.
Okay, this is like very specific context to the IRA, right?
I'm sorry, say that again.
This is very specifically in context to IRA, right?
Correct. Yeah. This is retirement, right? IRAs. Yes. Or
Okay.
retirement plans, I should say. Okay. So anybody else? I think George, unmute yourself there, buddy.
I'd like to know if it's advisable to put your self-directed IRA into a living trust. A
So,
living trust.
okay. So
I don't know if you've already talked about it. I
no, we
can't
have
even.
no. That is that's a left field question. Okay. So first of all, um, yeah, I don't really advise on anything. Okay, number one, but you know, IRAs are um, what you're going to do when you set up the account, and this is true of all IRAs. Okay, if something happens to you, it passes directly to the beneficiary named in the paperwork. So if you name your spouse, then it's going to pass directly to her. Okay. If you name your children, it's going to pass directly to them. So, living trusts or revocable trusts and those sorts of things are set up to avoid probate primarily. Okay. And as retirement plans, generally speaking, are non-probatable anyway, because they move directly from, if something happens to you, somebody inherits that immediately. So it's not assuming that you've named a beneficiary. So with us, you can't
Okay.
open an account without naming a beneficiary. Now you might name a trust, okay,
Okay.
instead of a person.
Yeah.
Um, not, but that becomes, I think that becomes a question for either your estate planner, tax person, those sorts of things.
Got you. Thank you.
Yep, you bet. Anybody else? Any other questions? Okay, well, I think I think we, beat this subject to death for a night. I appreciate everybody's time. If you're like me, and in the dead of night you come up with a question or something of those things, write it down. Don't call then. Write it down. Email us or call us. We'll be more than happy to help you however we can. Um, we obviously we hold this meeting once a month. It's usually the fourth Tuesday of the month, and so please don't hesitate to join us. if you have other questions, and hopefully I'll see you soon, and we'll talk again. Thank you very much. Bye
Thanks,
bye.
Jack.
You bet. Bye bye.